We often hear from foreign executives and lawmakers that China's markets are not open enough. Market access has been a persistent, thorny issue raised by those seeking to do business here. Now, many are looking to this year's two sessions for further guidance on where China stands on its market opening process. Are there still checks and curbs on doing business in China? Of course. There is no purely open economy anywhere in the world. But policymakers in this country have to tread especially carefully when it comes to the markets. One faulty move could be greatly magnified in a country with close to 1.4 billion people. Now, having said that, China's economy is more open than you think. Here's why. Number one, there are misconceptions about the mode of starting a business with foreign companies here in China. One of them is that you have to enter into a joint venture or a JV if you want to do business here. Sure, you can enter into a JV, but the truth is, for every single year that data is available, the number of wholly foreign-owned enterprises, or WFEs approved, far outnumber that of joint ventures by a mile. WFEs don't require a Chinese partner in business operations. Since 2006, when records began, WFEs outpaced JVs on average by 4 to 1. In 2018, the number of wholly foreign-owned enterprises approved was nearly fivefold versus joint ventures, the highest on record. Number two, China's policymakers have taken numerous, consistent steps to open up the economy in recent years. It may be lost in the details of trade frictions and macro indicators, but the actions are there. For example, by early 2018, non-administrative license approvals have all been canceled, and investment projects, which require verification by lawmakers here in Beijing, have been slashed by 90%. The time it takes to start a business here in China have been cut by at least 1/3. These are just a few of the plethora of moves that China has undertaken to open its economy even more. Number three, at its current development stage, China's weighted tariff rates are lower compared to its neighbors Japan and South Korea when they were at a similar or higher development stage. The latest numbers from the World Bank show China's weighted tariff rate coming in at 3.83% in 2017. Now, that corresponds with a Chinese per capita GDP of around $8,800. When South Korea had a similar per capita GDP, its weighted tariff rate stood between 6.8 to 8.5%, or at least 3 percentage points higher. In the earliest year from when data is available, 1988, Japan's weighted tariff rate came in at over 4%, but that's when Japan already had a GDP per capita of over $25,000. So it's important to put China's current market opening in context as well as in perspective. If China's economy is truly that difficult to access, sales of multinationals based in China wouldn't reach hundreds of billions of dollars annually, and China wouldn't always rank number one or number two in the world when it comes to attracting foreign direct investment. From raising or eliminating equity caps to hosting the world's first expo dedicated to imports, from a new foreign investment law focused on further widening market access to building free trade zones. The messages and measures from China are clear. The country will continue to open up even as global growth moderates and economic uncertainties abound. But have patience. Give China time. 40 years of reform and opening up is not enough for such an extremely complex economy. Policymakers in China take a long-term view when it comes to economic development. It does things in a gradual manner to ensure stable growth. Sometimes this can conflict with the quarterly or annual mindset of corporations. But China will remain squarely on the path of opening up. So stay tuned and be on the lookout for more measures in that direction.